Okay, welcome to another video, and in this video we are going to be looking at one of the topics in a previous edition of the weekly macro themes, which is the report for institutional investors and portfolio managers that we produce. Now the one that we're going to be looking at is this one, number 2, rate hikes and S&P 500. When is enough enough? And it sort of follows on from the first topic, which was Fed rate normalization well underway. So let's kick into it. Here we go, topic number 2. So the bottom line here, let's start with that. Fed rate hikes are gradually becoming a headwind to equities, but on absolute levels and relative to wage growth, monetary policy remains supportive. Right, so what does that mean? Well, first of all, really what we're trying to do in this topic here is have a look at how the Fed funds rate impacts on the S&P 500. So how does it impact on the market? And I guess at this juncture, it's really how does it impact on the market in terms of, kicking it into a bear market or a correction. And so, you're thinking about interest rates, they're pretty much the key tool for monetary policy. And, that has a massive impact on the economy, on confidence. And, it's quite intuitive that it would have an impact on the market. So we're going to have a look at a couple of different angles here. The first one's going to be the level. The second one is going to be the rate of change. This chart here. And then the third one is going to be putting rates into context, which is to bring in a bit of an economic context there. So we'll get into that afterwards. So first one is really the level. If you look back at the previous two major market peaks, both of them, you had a very big run up in the interest rate to, relatively speaking, very high levels compared to where it was, in previous times. And, at this point, it's fair to say that the level is not an issue. But, if you look at this red line here, so this red line is about bringing in the impact of quantitative easing. We call it the shadow Fed funds rate. And this becomes quite interesting when you look at the rate of change. So we've got the year-on-year rate of change here, and you can see that as the Fed embarks on a tightening cycle, easing cycle, you can see how that deviates from the zero line, and how that you can see how that's having its impact on the market there. When it becomes its most tight, that's pretty much a sign of the point that you probably want to become more cautious. And looking at the red line, this red line shows you what the rate of change of the shadow Fed funds rate. And you can see there that it really started to become a tightening influence shortly before that sort of market turmoil patch that we had there. Those little twin corrections, they're still meaningful, but they weren't a bear market by any means. And if you sort of compare and contrast these two charts here, I guess you can kind of understand why. So yes, you had a significant, very major tightening through here in terms of rate of change. And, part of the way that actually did impact on the markets was that it catalyzed the move in the US dollar and the commodity weakness. And really that was a big, if not the key driver of that. But when we had that market turmoil, it wasn't a bear market, and one reason perhaps why was that the actual level of the Fed funds target rate itself was still very low. And so if you think about the two key ways that impacts on the market, so the first one is in terms of the actual companies. So it means that they're still being valued on a very low discount rate, for one. But the other thing is it means that they're going to be still having very low cost of funds, so sort of monetary or financial conditions point of view. The other thing is, for consumers, for investors themselves, if you're thinking, where do you go to get income? You don't go to cash. All cash can do is preserve capital for you. And, if you're at all concerned with returns, you're almost forced into the stock market, the old TINA acronym, there is no alternative. And I believe that was probably a key driver of why you didn't get a bear market as a result of the severe tightening that we saw, at least on the red line. We're starting to see the grey line move up as the Fed has sort of restarted, renewed its initiative on the rate hiking front, and expect that to continue to gradually move up. But it just goes to highlight too that you sort of need to look at them both, because if they go very slowly, then the rate of change isn't going to be incredibly onerous. But if they start to really ramp things up, that's when it can become a bit of an issue, as it did around this time. And in thinking about parallels here, this market environment around the dot-com boom has many more parallels to what we're seeing in this environment versus here. So this one probably is a better one to actually look at. And as I promised, the third element, and again, this is probably another reason why in hindsight we didn't get that turn from a correction into a bear market, was because this indicator was very strong. And you might be sitting there thinking, he's talking a lot about history and explaining the past a lot, which is kind of interesting, but how do you use that? Well, the point is, once you understand history and what's been driving it, then you can understand where we might be going in the future as a result of these indicators. If they're providing a good guide on explaining market turning points, then that's something that we can definitely use. And so we look at this one here, and it was actually at the probably one of the most supportive levels it's been at least in the history of this chart. It was actually as supportive as it has been around the major market bottoms that followed the last two major market peaks. And so what is this indicator, and why do we use it? It is quite simply the difference between wage growth and the level of the interest rates. And the reason why I decided to put that indicator together was for a few reasons. First of all, I was just curious and wanted to see what it looked like, and found that it looked actually pretty good. But if you think about the rationale behind it, so there's pretty much two ways that it works. The first one is a confidence driver. So if you're a consumer and your income is going up at a pretty good rate, as it's sort of started to now, that sort of 3% plus level. If you're seeing pretty good income growth and your cost of funding is very low, then that's pretty good, right? I mean, from a confidence standpoint, that's a set of conditions that are very supportive. And I guess on the other angle, from the economic standpoint, that's the kind of scenario that's good for the economy. If you just look at housing alone, if incomes are going up and the cost of borrowing is contained or at a relatively low level, then that's the kind of thing that puts a lot of support into the housing market, and also more broadly into consumers' spending capacity. And by the same token, if you look at the point where it becomes a drag or a net headwind, so down, I guess any time where it's sort of above that 2% level, 1 to 2% level is clearly a strong tailwind, the spread between them. But then when you get into this part where the Fed starts to hike quite aggressively, and to the point where the Fed funds rate is higher and has been rising faster than the pace of wages, well, if you think about an economy like that of the US, if the consumer is seeing their cost of funds going up, most consumers, their biggest expense is their mortgage. And so if their mortgage expenses is really starting to heat up and they're not getting enough income growth to actually offset that, then that's the kind of thing that really acts as a proper material headwind. And when you encounter a situation like that, then really it's only a matter of time before the market rolls over. And you saw as it became more accentuated in these two parts here, you know, in 2000 and then into 2007. You know, yeah, sure, the market went up a little bit further, but it was really only a matter of time before that worked its way through the system. And, you know, thinking about where we are now, we're miles away from there. I mean, to actually get that kind of condition, you'd actually need wage growth to roll over, which of course would have its own issues, and of course the stock market's not going to do very well if wage growth starts to plunge. But, you know, from the rate hike standpoint, the Fed's going to have to be very aggressive, you know, to get up to that sort of 3%, 3.5% level from 1.25. That's, you know, that would be a very aggressive rate hiking cycle. I think that they probably will get towards that level, but, you know, over probably a year or two. So, you know, on this indicator, it's still giving the all clear, but, you know, it's definitely one to keep an eye on. And, you know, again, if we come back to the question, rate hikes in the S&P 500, when is enough enough? So let's just quickly go through to recap. When is enough enough? When is enough Fed rate hikes enough to actually cause the market to go into a bear market? The first chart, the level has to be high. So, you know, the cost of funding has to be high. The, you know, the attractiveness of cash versus other assets has to be high. The rate of change, so the second chart, has to be very, you know, contractionary, very sharp in order to cause enough pain. And then thirdly, finally, you know, you need to put it into its right context. If rates are going up very quickly and to a very high level, but wage growth is being, you know, very bigly heading along very fast, then, you know, that could probably still carry on. But, you know, the moment that the light blue line passes above the dark blue line, then, you know, that it's only a matter of time. And so I'll just leave it there, and if you've got any questions, please do put them in the comment section below, and be sure to subscribe to our YouTube channel. And if you wanted to take a closer look at this report or any of our other reports, then please do get in touch.